Have you been watching your crypto bags just get their asses kicked recently? Painful, I know, but one market is dropping and we actually want it to, because while Bitcoin's been kind of stuck above 100K, but not really breaking out, and altcoins been getting their butts kicked nonstop, the bond market is actually flashing a signal that historically predicted every major bull run. So stick around, because this could be the move that wakes the crypto markets up finally. So let's do a quick crash course on bonds. Not that bond, not James Bond, the boring bonds, okay? Because once you get what's going on with bonds, everything else will just click. When the US government issues a bond, it's basically borrowing money. You lend them $1,000, they promise to pay you a fixed amount every year. Let's say that's gonna be 50 bucks, okay, or 5%. That 50 bucks is called a coupon. Now the coupon is fixed. You always get that 50 bucks no matter what happens in the secondary markets for the trading of those bonds. So when you first buy it, $50 on a $1,000 bond is 5%, which is easy enough to understand, right? But things start getting a little more complicated, okay? The bonds don't just sit still. There's a very big open market for them, and they trade in those markets. So if investors buy a lot of those bonds, the price of the bond goes up. Let's say the bond price climbs to $1,100. The coupon is still $50 guaranteed, but the yield is not 5% anymore. It's 4.5% for anybody who buys it at $1,100, because that $50 divided by $1,100 gives you a smaller return. That's why we say bond prices and yields are something that move in opposite directions. It's kind of like a seesaw. When prices go up, yields go down. And right now, the US 2-year Treasury bonds, basically the market's all-time favorite crystal ball for where Fed policy is heading, guess what? It has been trending lower all year. And that is a big deal, because falling yields mean buyers expect the Fed to start cutting rates much more aggressively. So they're locking in those fixed coupons right now before yields drop even further, which by all intents and purposes, that's what the Fed's gonna do. All that buying pushes the prices up and the yields down. That's the market's way of quietly signaling the rate cuts are coming. And here's where your dog coins come in, okay? Crypto, Bitcoin, all that kind of stuff, right? Bitcoin, the Fed fund rate, and even the US dollar index to the DXY are all connected through liquidity. When bond yields top, it's not just some number we hear from economists. It shapes the markets, the entire plumbing of the financial system. To understand, all you need to do is look at the charts. We're all familiar, of course, with the inverse correlation between the DXY, or the dollar index, and BTC. If you look closely, Bitcoin also tends to move the opposite of the Fed funds rate and the 2-year Treasury yield. When bond yields fall, safe starts looking real boring real fast. Investors don't want crumbs for their money. They want growth. They want to beat inflation. They want to make money. So money starts rotating out of bonds and into riskier plays. Stocks and crypto, of course, have been absorbing a lot of that. When the so-called risk-free return dries up in bonds, the risk-on trade wakes up. And that usually is when the real fireworks start to begin. Now let's just for a quick moment rewind to the 1990s, the era when PlayStation was first introduced. We're all sitting around as teenagers playing Lara Croft, or at least for a millennial you might have been. Anyway, the Macarena was still a thing and needed to literally dial a number to get 56 kilobits per second speed data. Took ages to download pictures of boobs, man. But it was also an era when the Federal Reserve started easing rates, and markets went absolutely freaking nuts. In 1995 alone, the Fed delivered 3/4 point rate cuts, July 6th, December 19th, and then January 31st, 1996. Each move injected more liquidity in the system, lowering borrowing costs and giving investors confidence to chase risk. You'll see a chart that goes around a lot saying every time the Fed cuts rate, it results in a giant recession and horrible bear market. Except the 1990s, when they cut when the market was growing. Dot-com bubble happened, okay? Look, investors will chase risk. They did back then. From 1995 to 1997, the S&P 500 surged year after year with gains of 37.2% in 95, 22.7% in 96, and 33.1% in 1997. These are crazy numbers, guys. That kind of momentum fueled the dot-com boom and created a classic risk-on environment. Safe assets looked pretty effing boring, and investors eagerly moved into anything with upside, which was basically anything that was not bonds. This environment creates a flywheel that fuels the boom, which is exactly the situation we're in right now, by the way. And yeah, nothing goes up forever. The dot-com boom led to the dot-com crash. But that doesn't mean you can't ride the run-up. Just remember to sell something at some point, right? Bitcoin didn't exist back then, but the same logic applies today because the same financial conditions are here now with us. When yields drop and the Fed opens the tap, liquidity leaks into everything. In the 1990s, stocks, of course, were the risky assets. IPOs were the risky assets. New internet companies were the dog coins of the day. In fact, we even had pets.com, which is basically the dog coin of stocks. This kind of environment sparks a risk-on attitude that can lift almost everything. Now, before we get into the rest of this story, guys, if you're trading crypto, Bitcoin, Ethereum, Solana, dog coins, you got to get yourself an account over in BitUnion because it's the hot spot to be trading crypto coins at. Now, you have to ask yourself the question, will you start taking your crypto trading seriously, move to an exchange that rewards you to actually come over and trade there? That place is BitUnion. No KYC, no VPN to be able to anyone, anywhere. That's you. And you can get up to $700 in deposit bonuses. That's crazy. Put in $10K, they give you $700 cash back. Crazy trading bonuses, and we're giving away $1,000 in every single live stream. If you want to be in to win that $1,000, you got to be signed up. There's a link down below. Go check it out. Bond yields aren't the only things traders are watching. Analysts are also tracking other signals that could influence the Fed, and there's a lot of stuff going on, a lot of moving pieces. Many now expect the Fed to deliver a quarter-point rate cut at each of its next 3 meetings. Why? Well, a recent report showed consumer inflation rose slightly less than expected last month. The CPI, or the Consumer Price Index, climbed 3% year over year through September. That's higher than August's 2.9%. Yes, but everybody was expecting 3.1%, so it came in cooler than expected, meaning inflation's rising slower than economists think. And it might seem like a pretty small difference, but in macro terms, even a fraction of a percentage point can move markets pretty dramatically, and sentiment in markets and expectation of how the Fed will react to data. Lower than expected inflation eases pressure on the Fed to keep rates high, and that can shift the entire risk landscape. The more the Fed cuts, the more risk the markets take. Even Polymarket right now is pricing a 99% chance that this rate cut will happen later this week. And starting to think, of course, betting platforms are, not betting, prediction markets platforms are the real crystal balls we should keep an eye on here. And look, I know if you've been a crypto investor, it's been a hard year, especially for a lot of the altcoins, and a lot of you may be tired of waiting for the market to actually do something. Bitcoin tried to break toward 130K 3 times, only to get smacked down every time. Altcoins have just been nonstop, relentlessly shit on. Many haven't even come close to sniffing out previous all-time highs, and many probably never will. Ethereum did get a new high, but just by a little bit. Couldn't even get through $5,000, okay? It's enough to make you want to throw your damn laptop out the window. Watching crypto tease you like this is like waiting for your pizza delivery, only for the delivery company to call and say, we're stuck in traffic. You're getting cold pizza, man. Sucks. But you still get pizza at the end of the day. But even when it happens, you can't help but checking the tracker every 2 minutes. Where the hell's my pizza at, man? The good news, the setup is looking cleaner than a portfolio liquidated by margin calls. Too soon? Too soon, isn't it? Anyway. Falling bond yields, potential Fed rate cuts, and liquidity trickling back into risk assets are all lining up, and the Fed's even ending their QT program, which is going to add a lot of ease into the markets by taking off that continual pressure. Stocks will, of course, continue to run. Bitcoin will also run, and yeah, even some of your dog coins are probably going to drag up along with the rest of the market. And by the way, if you love macros, and you love equities, and you love crypto, guys, we've got an insanely free, awesome newsletter. Links right down below. Go check it out. You got all the latest insights. It's free. It's awesome. You're missing out. So, I know it's been a crazy waiting game. I've been here too. But the patience will pay off. The struggle will pay off. The charts, the macro signals, the bond market, they're all hinting that this bull run is not only not done yet, but has got a lot of fuel left in the tank. In fact, it might just be gearing up for its next big leg right now. We've waited this long. Be ashamed to tap out right before the things get crazy, man. Thanks for watching.